What if one stock could pay you three different ways, over and over, without you ever needing to guess where the price goes next? Most people think investing means picking a direction, up or down, win or lose, but there's a strategy that doesn't care which way the stock moves. It just keeps paying you. It's called the wheel, and once you see how it works, you'll wonder why more people don't use it. Let's start simple. Imagine a stock you actually like, not a random ticker, a real company you'd be happy to own for years. That part matters more than anything else in this strategy. Why? Because the wheel only works if you're comfortable owning the stock at every single step. If you wouldn't want to own it, skip it. This isn't about gambling on a name you heard once. This is about getting paid to wait for a company you already believe in. Here's where the wheel begins. You sell something called a cash-secured put. That phrase sounds complicated. It isn't. Selling a put means you're making a promise to the market. You're saying, I will buy this stock at a specific price if it ever drops that low. In exchange for that promise, someone pays you cash today. Right now, before anything else happens, think of it like a deposit. A stranger wants the right to sell you their stock at a price you both agree on, but only if the price falls to that level. For that right, they pay you up front. That payment is called a premium, and you get to keep it no matter what happens next. So what actually happens next? There are only two outcomes. Only two. Let's walk through both. Outcome 1. The stock stays above your price. It never drops low enough to trigger your promise. In this case, nothing happens to your shares because you don't own any yet. Your put simply expires, and you keep the premium, full stop. You got paid and your obligation disappears. Isn't that strange? You made money without ever owning a single share. Outcome 2. The stock drops to your price or below it. Now your promise activates. You're required to buy the stock at the price you already agreed to. But remember, you already got paid for agreeing to this. So your real cost is lower than the price on the label. You didn't get trapped. You got the stock you wanted at a discount you already profited from. This is the first turn of the wheel. Selling the put, either for pure profit or for a discounted entry into a stock you wanted anyway. Now, let's say the stock did drop. You now own shares. What happens next? This is where most investors would just sit and wait, hoping the price climbs back up, but the wheel doesn't wait quietly. It keeps working. Now you sell something called a covered call. A covered call works almost like the reverse of what you just did. Instead of promising to buy, you're promising to sell. You tell the market, I will sell my shares at a certain price if it ever climbs that high. And once again, someone pays you cash today, immediately for that promise. Here's the beautiful part, you already own the shares, so this promise is fully backed. There's no risk of not being able to deliver. That's why it's called covered. You're covered because the shares are already sitting in your account. So what happens now? Again, only two outcomes. Outcome 1. The stock stays below your call price. Nothing gets triggered. You keep your shares and you keep the premium you were paid. Your shares are still yours, plus you're a little richer than before. Outcome 2. The stock rises above your call price. Your shares get sold at the price you agreed to. You already collected a premium for agreeing to this. So you profit from the stock going up and you already banked extra cash on top of that. Either outcome, you got paid. That's the wheel. Sell a put. Either collect cash or get assigned shares at a discount. Then sell a call on those shares. Either collect more cash or sell your shares for a profit plus the extra income. And when your shares get sold, you're back to step 1. You sell another put. And the wheel turns again. Why does this work so well? Because it removes the guessing game. You're not trying to predict the exact top or the exact bottom. You're getting paid at every stage of the process, no matter which direction the stock decides to move. But here's a question you should be asking right now. Is this free money? No. Nothing in the market is free. If the stock crashes far below where you bought it, you're still holding shares that dropped in value. The premium you collected softens that fall, but it doesn't erase it completely. This strategy still requires picking companies you're genuinely willing to hold through a downturn. There's also a trade-off on the upside. When you sell a covered call, you're capping how much profit you can make if the stock suddenly rockets far past your call price. You'll still profit and you'll still keep your premium, but you won't capture every dollar of a huge surge. You're trading unlimited upside for consistent, repeatable income. Does that trade-off sound worth it? For a lot of investors, yes. Because the wheel isn't designed to catch lightning in a bottle. It's designed to turn a stock you already like into a steady paycheck month after month, whether the market is calm, choppy, or slowly climbing. Let's walk through the full cycle one more time, so it clicks completely. You pick a company you trust, you sell a put below the current price, and you get paid immediately. If the price never drops that low, you keep the cash and repeat. If it does drop, you buy the stock at a discount you already profited from. Now you own shares. You sell a call above your cost, and you get paid immediately again. If the price never rises that high, you keep the cash and repeat. If it does rise, your shares get sold for a profit, plus the extra income you already collected. Then you start over. Same stock, same wheel, new premium. This is why traders call it a wheel. It doesn't stop after one trade. It keeps turning, collecting small payments along the way, using a stock you are already comfortable holding. Your ancestors never had to think about probability like this. They reacted to threats and opportunities in the moment because hesitation was expensive. But the wheel rewards a different instinct entirely. It rewards patience, structure, and a plan you set before emotion has a chance to take over. So the next time you look at a stock you actually believe in, ask yourself something different than most people ask. Don't ask, will this go up tomorrow? Ask, how can I get paid while I wait to find out? That's the wheel. Sell a put, get paid, or get a discount. Sell a call, get paid, or get a profit. Around and around, one turn at a time. If this video helped the wheel finally make sense, that's exactly why this channel exists. Thank you for watching all the way through. If you want more strategies broken down this clearly, subscribe and turn on notifications so you never miss the next one. See you in the next video.